Assalamualaikum and a very good day to Sir Zarul Naim, our respected financial management lecturer. Before we begin further with our presentation, I would like to introduce my group members consists of 3 members, which are Alia Nazifa binti Syahrul Nizam, Nur Syurahanim binti Naz Aizan, and me, Nur Hidayah binti Bakar. We as a team will be presenting on our financial ratios for the company Coco Lines Holdings Berhad for the year 2020 and 2021. Before we jump straight to the ratio, let me introduce this company. Firstly, I would like to introduce you about Coco Lines Holdings Berhad. Coco Lines Holdings Berhad is one of the leading manufacturers of confectionery products in Malaysia, such as chewing gum, sugar canes, wafers, snack and beverage. Recognizing the need for additional capital as well as favorable brand recognition, Coco Lines Holdings Berhad was incorporated on June 6, 2000 and listed on the second board of Bursa Malaysia Securities Berhad on July 18, 2005 and successfully converted to the main board on July 18, 2006. Today, Coco Lines Holdings Berhad has 5 subsidiaries which I have listed in this slide. Not only that, Coco Lines products are now available not only in Malaysia but also in international markets. In my left side, there is the popular products from Coco Lines company. So, the first ratio, which is liquidity ratio. Liquidity ratio measures a company's ability to pay debt obligation and its margin of safety through calculation including current ratio, quick ratio and net working capital. In 2020, Coco Lines company current ratio is 9.55. Decreased extremely to 7.79 in 2021. This is not good for the company because company may not be using their assets well and they will get higher risk of difficulty or fail to pay. For quick ratio in 2020 is 8.36 and dropped to 6.69 in 2021 due to struggle to pay their current liabilities because of the lowest ratio in 2021. In 2020, the net working capital is 247629,375 ringgit, declined to 243321,012 ringgit because they have too much inventories.
Okay, let's move to the second ratio, which is efficiency ratio. Efficiency ratio measure a company's capacity to effectively use its asset and manage its liabilities in the present or short term. Although there are a variety of efficiency ratio, they all assess the time it takes to earn cash or income from a client or to liquidate goods. So, the first example in efficiency ratio is inventory turnover. Inventory turnover can exist firms in making better pricing, production, marketing, and inventory purchase decisions. When the ratio value of a year is high, then the efficiency level of the year will be better. So, in the slide, in 2020, the inventory turnover is 4.69 times, which is more than in 2021, which record only 3.94 times. So, the efficiency level in 2020 is better than 2021. Next, the fixed asset turnover, which is second example in efficiency ratio, is important in some industries. An investor or analyst must first determine whether the company under consideration is in the correct sector or industry for the ratio to be calculated before giving it considerable weight. So in 2020, the value of fixed asset turnover is 1.79 times while the value has increased in 2021 to 1.85 times. So the last one, the third example in efficiency ratio, which is total asset turnover ratio, that compare the value of a company's asset to the value of its sale or revenues. In 2020, the value of total asset turnover is 0.78 times, but that value has decreased to 0.75 times in 2021. So efficiency level are declining from 2020 to 2021.
Next, I will present about the company's leverage ratio. A leverage ratio measures the level of debt being used by a business. Leverage ratios are measured to find out how a firm finances its assets and to determine its capital structure. It is any of a number of financial measures used to evaluate a company's ability to meet its financial obligations. Firstly, the debt ratio in the year of 2021 shows an increase of 0.03 times compared to the year of 2020, which from 0.10 times to 0.13 times. Debt ratio that shows a higher ratio reflects a higher amount of debt to finance assets. This indicates that Coca-Cola Company has more debt to incur. Next, the debt to equity also showed an increase of 0.03 times in the year of 2021 compared to the year of 2020, which is from 0.12 times to 0.15 times. In this context, a higher ratio reflects a higher amount of debt such as capital structure. Next, in year 2021, time interest earned was found to increase by 7.39 times compared to year 2020, which is from 13.34 times in the year of 2020 to 20.73 times in the year of 2021. In the context of time interest earned, a higher ratio indicates that the firm can meet loan requirement and a lower risk of default.
So, the last ratio is profitability ratio. What is profitability ratio? Profitability ratio are a group of financial measures that are used to evaluate a company's ability to create earning over time utilizing data from a single point in time. So, the first example in profitability ratio is gross profit margin. Analysts use gross profit margin to evaluate a company's financial health by estimating the amount of money left over minus the cost of goods sold. So in the slide, in 2020, the value of gross profit margin is 25% and increased to 26% in 2021, and a high percentage value gives a good level of contribution margin. Next, the operating profit margin. Operating profit margin measure how effectively a business can produce a profit from its main operations. So in slide, in 2020, the operating profit margin is 13%, while in 2021, the value has increased to 40%. So the productivity in 2021 is better than 2020. So the last one is returns on asset, that refer to a financial ratio that measure a company's profitability about its total asset. In 2020, the value on return on asset is 7% and increased to 8% in 2021. Hence, the return on investment in 2021 is higher than in 2020.
Okay, now let's move to the next point, which is suggestion. Financial performance is very important in determining the business success of a company. If a company has a good financial performance, of course, it shows that the company is wise in managing its finances. To
improve the company's financial performance, Coca-Cola should improve its marketing even more. This is because too many competitors are selling the same type of product. By improving the marketing strategy, it will definitely be able to attract the public to buy loyal to this company. The use of social media to promote product is the best move, given that today's world is more focused on the use of social media such as Twitter, Instagram, and Facebook. With this, the company's profit will increase and indirectly improve the company's financial performance. Moreover, keeping up to the accounting record is also one of the actions that the company can take to improve the company's financial performance. If your account is not updated, you may lose money because of failing to keep up with late customer payments or failing to know when you need to pay our provider. A good record keeping system will help you keep track of your expenses, debts, and creditors, apply for additional financing, and save time and money in accounting. Lastly, consolidate the debt. Consolidated debt provides better repayment recognition with 9 lower interest rate and smaller monthly payments. In other words, the company consolidates its obligation into a single payback with significantly better terms than if it had many loans. That's all for me. Thank you.